Hello everyone, Bob Scott here. In today's topic, we're going to be discussing why savers are losers. I've got my business partner, Jimmy Vreeland here. Jimmy, you want to say hi to the folks out there?
Hey, everybody.
Okay, so why are savers losers? Jimmy, what are your thoughts?
You earn less than 1%. It doesn't beat inflation. So, in my mind, you're actually losing money because of the huge opportunity cost you have of keeping that cash in a bank for 1% that's taxed. So, it's really half a percent interest that you gain.
Yeah, so your savings account's earning you maybe 0.5% after taxes, and I mean, on the low end, I think inflation's estimated at what 3% these days, and that's if you go by standard government numbers.
If you believe those,
You believe
sure.
those, sure. Assuming they're right, you're losing 2.5% of your money each and every year. So that's it.
Okay, end of webinar.
Pretty simple, right?
As entrepreneurs, as real estate investors, we can't afford to have our money earning less than inflation. The whole
No.
point of getting into real estate is to short the dollar and to win the inflation war.
Well, not
But
even
that's
just
another
yeah,
webinar that
not
we
even entrepreneurs or business people. Anybody, nobody with any type of capital that's been saved up can afford to lose money. You work so hard to make it in the first place, and then after taxes are taken out and after you pay everything else, the little you have left, you need to make sure is in a safe place. And is earning you as much as possible. All right, just joking. We've got a few more slides here for you, folks.
And here's a disclaimer: we're not economists, we're not historians. We are students of entrepreneurship
We're
and
closet economists, self-taught economists.
sure, we are students of Austrian economics and we're entrepreneurs and we try to learn from history so we don't make the same mistakes. So we're going to run through a quick history of banking. We'll list several resources at the end of the webinar that tell this story better than we are.
Yeah. So where did banking start? Originally, gold and silver was used as money, and if you've ever picked up a gold coin or a silver coin, if you have a lot of it, it's actually pretty heavy and kind of a pain in the ass to carry around. And it could also get stolen. If you're walking around with 20 gold coins on you down the street in your little purse bag, a thief could run up to you and pretty much take your life savings. So after a while, people decided they were going to start leaving their gold with the goldsmith and put it on deposit there for safekeeping. Because the goldsmith obviously had to secure his shop and he had kind of a secure premises and is a good place to store gold and silver. The goldsmith would give people a deposit slip back for the money that they left there. And originally this was probably a little handwritten receipt, and eventually they got into a little bit more standardized notes and something that would prove to the goldsmith that it was actually theirs, that they couldn't be counterfeited, so the goldsmith wouldn't get ripped off. And eventually, people started trading their deposit slips back and forth for ease of use. Because imagine you're going to buy a horse, and you give. It's much easier to give the guy you're buying it from. Let's say I'm going to buy a horse from Jimmy, right? And it's going to cost me, 2 gold coins. Instead of going all the way to the goldsmith and giving the goldsmith my receipt, giving the 2 coins, and then taking that to Jimmy, I can just give Jimmy the receipt, and if he wants to pick it up, he can.
And these different notes had different values because if Goldsmith Jones was a more honest, more reliable goldsmith and people trusted him more, they'd be more willing to trade a Goldsmith Jones note.
Yeah, exactly. So eventually, the goldsmiths realized that people rarely redeem their gold, and that they could actually loan out what was in deposit and start earning some extra interest off of that. They're enterprising businessmen. They're looking for a way to make a buck. This is a pretty good idea.
And
And
this is the beginning of fractional reserve bank.
well,
It's
originally at
fine
that
that the
point,
goldsmith did that, but he
yeah,
needs to say these are not cash on demand deposits.
yeah,
There's a
yeah. I mean,
distinct difference.
probably in the beginning, it wasn't a fractional reserve system. They did have the reserves in the bank to support what was lent out.
But that
Um,
first greedy goldsmith that we're talking about created this system.
I don't know if actually we'd have to look at the history of fractional reserve banking, but if I had to guess, it probably really didn't come into much of a play until the government got involved. Back with the
So
free
explain
market.
why a king would like that.
Well, king's a government, isn't he?
Well, it would. We're not talking Mesopotamia right now. We're talking probably Renaissance Europe.
Yeah, there's some type of transition here. Obviously, it goes from being a goldsmith to a banker over time because, the free market comes into play. And as Jimmy mentioned earlier, there's some competition and bankers can say, hey, If you put your money with me, I'll pay you a little bit higher interest. So eventually, that's kind of where the transition happened. Goldsmiths became banks, and they would offer depositors a share of the interest on the money they lent out. And in order to get as much business, as much deposits as possible, they would have to offer a fair rate of return to the depositors. So
nice history lesson, Jimmy and Bob. Who cares? We really like that you are real estate investors and want to ruminate about the history of banking. That's great. Why do we care? Well, we'll tell you why it matters. So we went through that history lesson to explain what the true purpose of a bank would be. We could call it, in a free market, purpose a bank should serve as a place where you could keep liquid cash and earn a little bit of interest in order to do that.
And add a lot of convenience to your life, right? Convenience, and protection and safekeeping, right? So somewhere along the line, this purpose in the marketplace got blurred, and we got into the system we have today, which involves the Federal Reserve Bank and the fractional reserve banking system. For those that aren't familiar, fractional reserve banking is where more money is lent out than the bank actually has on deposit, right? So that initial example, we said, okay, the banker says, let's say I've got just $10,000 for round number of deposits on hand. Well, if I loan out $10,000 worth of notes, those notes are still never going to be called out, are never going to be redeemed all at once. So it can actually loan out, let's say, $20,000 worth of money and still only have $10,000 in hand. And at some point, this just starts getting really dangerous, because an economic downturn or some sort of crisis, when people need liquid cash in a crunch, there's a chance that all those people could come back and demand their deposits at the same time.
Which is called a run on a bank.
Yeah,
and it's not really a chance in an economic downturn there'll be a run. It's a certainty.
Yes, yeah.
Everybody's going to say to themselves, I know the bank doesn't have enough cash to cover everyone, so they don't want to be the last person in line to get their cash out of the bank.
Yeah, what's that movie?
The most common example is It's a Wonderful Life, and there's a run on the bank. So there's a bunch of debate amongst economists and historians. Is fractional reserve banking ethical? Is it legal? There's different types of banking. If people should not be depositing their money into a bank thinking it's a cash on demand deposit. That is a myth, that you could run into a bank and get the exact cash on demand that you want that day. And we're going to talk about that in a couple more slides. But a good example is like with our investors. They give us cash generally for a 2-year term. They know they cannot have liquid cash back for 2 years. They can have interest that we pay them every month or whatever time frame we agree to, but they know they're not getting their cash back. It's somewhat of a myth for a depositor in a bank in today's system to think they can have a cash on demand deposit. And for me, to make everything fair, the banks just need to explain that.
Yeah, it would be nice if they had full disclosure and actually, told you that they were loaning out more money than they had on their books.
They need Jimmy Stewart every time you go into a bank to deposit to say, your money's in Bob's house down the street and your money's in Joe's factory. They just need to understand that there's a fractional reserve system and all the cash is not there.
All right, so what are some of the other downsides of putting money in a bank today? Well, as we've mentioned, you're earning less than inflation rates, and the money you do earn is taxed. So you end up actually losing money by keeping it in a bank. And as Jimmy mentioned, your money is not actually liquid. You have to fill out paperwork for any transaction over $10,000. There's a lot of government oversight. And if you actually walked into a bank and ask for that money out, let's say you got $20,000 in your savings account or your checking account. If you walked into the bank and said, I would like to withdraw my $20,000, you would get a big fat no. It's not going to happen. And I don't. There's probably not many of you have tried it. I've tried it. I know Jimmy's tried it.
I've had friends who have tried to cash $5,000 checks and can't get cash that day.
Yeah.
One of my buddies, he had a $5,000 check and he was going to Vegas, so he wanted cash, and they were not able to do that for him.
Yeah, which is absolutely absurd if you understand what the purpose of a bank is for you, and you're not able to even access your own money. It's just not cool, really. That's what it is.
And the last bullet, you guys can go on to Mises.org. There's plenty of other people who will talk about this, but the fact that you can't put your liquid capital somewhere and get at least beat inflation, the people this absolutely crushes are people who aren't necessarily entrepreneurs, but are trying to save and work and then retire.
Yeah.
And
people are on fixed incomes too.
And we'll do other YouTube videos about this. It especially crushes people on fixed income. But you're trying to make a rational decision. And so it's technically going to force you into higher risk investments. There are some people who shouldn't be investors. There are some people who shouldn't be speculators.
Yeah, you're just going to be chasing that return just because you're so scared of losing your money by keeping it in the bank.
So you're going to go into the market because the myth is the only place to invest is Wall Street. For me personally, it really bothers me that if I want a transaction of over $10,000, I have to go beg the regulator at the bank to give me my $10,000 and to document that transaction. I mean, in the real estate business, how often are we doing $10,000 transactions?
Every day. Yeah, several times a week we do large transactions, and it's a real pain in the butt.
And like I said, I worked for this money. It's my money. I don't need a regulator I don't need to kiss their ring to get my money.
Yeah, couldn't have said it better. All right, so how many of you out there have read The Black Swan by Nassim Taleb? Great book if you haven't gotten into it. Just absolutely fascinating when he talks about it. He talks about it in there. Jimmy, you're a little bit more familiar with it than I am.
I'm a big Taleb fan and just the way he thinks. And here are the worst case scenarios that could happen in the present day banking system.
Well, what is a black swan for people out there who haven't read it?
Most people think swans are white, and they think it's beyond their comprehension that a swan is black.
Okay.
And I don't think they ever saw a black swan until they discovered Australia. So that's where it comes from, is that they couldn't change the classification of a swan. It was still a swan, even though it was black.
Got it. And it just blew people's minds, basically.
Yeah.
Okay. Cool.
So the whole point of the book is that you have to prepare for the unpreparable. You have to be able to think in certain ways. For example, 2008, people said the housing market would never crash. Once you hear that, that is a pure indicator that it's probably going to happen.
Never say never, right?
Exactly. So and the reason we put black/gray swans is that once you think about it, according to Taleb in the book, it then becomes a gray swan. As you got closer and closer to the real estate crash and more people started seeing what was happening, it became more of a gray swan, whereas like 2002, it was probably a black swan.
Yeah, because now you can do something about it, right?
You're at least considering the risk, and the risk is becoming more realistic.
Okay, so for all of you out there, this is now a gray swan conversation for what Jimmy's about to get into.
So here, when I heard about this concept, I was listening to the Laura Murphy podcast, and I was working out, and I had to stop and like sit down because I was so infuriated. So according to Dodd-Frank, the next time there is a crash, I'm not going to say it's likely, it's a black/gray swan event, but the next time there is a crash, there will not be a bailout where they go after the taxpayer as a taxpayer. There will be, and this is according to the Dodd-Frank.
So tell people a little bit more about the bailout for those that don't know. What exactly happened?
All of you remember in 2008. Well, I guess if we have millennial people watching this, they probably don't remember. In 2008, several of the banks were insolvent, and they went to the government saying, "We're too big to fail. You have to bail us out."
And by too big to fail basically means if they crash, the Bank of America's out there crash, basically the whole economic system was going to come tumbling down, right?
Exactly.
Okay.
So they had the taxpayers with the Fed create a bunch of money to give liquidity to the banks. And so they went after the taxpayers to bail out all the banks that could not. Okay. They went after the taxpayer to make the bank solvent.
Gotcha. And by going after a taxpayer, you mean they basically just inflated the money supply, right?
Exactly.
Okay, cool. All right, so get into bail-ins for folks.
Okay, so, and by the way, we're going to list further resources for you to learn about this, because we're not going to do it justice articulating it. But this is part of the reasons we don't put our money in banks. So what a bail-in means is they're not going to go after the taxpayer as a taxpayer. They're going to go after the taxpayer as a depositor. They are going to take deposits, and this has already happened in Cyprus, so it's already been done.
the precedent's been set, and it's
Yes.
actually for the Dodd-Frank whatever law that was passed. This is actually in there. It's actually written in stone. This is what will happen the next time there's a crash, folks. This
And
is
we're
not
not
like
going
a
to
what if.
we're not even going to talk about how Dodd and Frank are ridiculous politicians and got in trouble on their own right. So the fact that these two guys should be able to do anything about the assets of 300 million Americans is insane.
Yeah, and they obviously have no knowledge of actual economics. I mean, when was the last time those two had a normal job or provide any actual economic value in the first place?
But didn't Frank get in trouble for prostitution or something? So he understood free exchange. People
Yes.
wanted something.
True.
Anyway, so the bail-in and go to Laura Murphy, and there's several other financial resources we'll set you up with to understand this concept. But they are going to go after the taxpayer as a depositor now. They are going to say, your deposit is not your money anymore. We're going to trade you an unsecured piece of stock in the bank. And that is how they're going to get liquidity next time there's a crash.
Gotcha. Okay, so I've got my $20,000 in the bank, and crash comes. There's a run on the bank. People freaking out. The bank won't give me my cash, and then in order to keep the bank solvent, they're going to say, okay, Bob, now you are a shareholder in the bank, and you get X percentage based upon your $20,000.
And you're an unsecured shareholder.
I'm unsecured.
So you're the
what does that
lowest
mean?
in the totem pole.
Okay.
That means you have a piece of paper. You don't have money anymore.
Well, okay. Money is just a piece of paper too, but an even more worthless,
a little more worthless piece of money.
Another tier lower than actual.
But like we give our investors a note and deed of trust.
Yeah.
It's their title to the property.
Yeah, it's secured in the property, so it's more than a piece of paper.
Secured investor. Yes, they are going to have title to jack and shit.
So I become a shareholder in a bankrupt bank, basically.
Exactly.
Okay, cool.
And so it'll be Russian roulette. Do we declare bankruptcy or not? And you're a creditor now, so they could declare bankruptcy, and you're left with nothing.
Okay, but I thought FDIC was around to kind of prevent all this from happening. No?
Just Google it. It's underfunded.
Google it? Okay,
Yes.
all right.
It's underfunded.
What do I Google? FDIC underfunded?
Yes.
Or FDIC is a
You
sham?
Whatever, but Google do it right now. See what pops up.
Should I Google FDIC as a sham?
You Google all of it. Let's learn together.
Okay, I like this.
And we don't have time to get into when the FDIC was created and whatnot.
Okay, what about this problem banks list for folks here? Oops.
FDIC
Stop
illusion.
making it big. All right, so we're here at the old Google, and this is the FDIC.gov.
Remain underfunded until.
What are the headlines? All right, yeah. FDI Deposit Insurance Fund remain underfunded until 2017. All right, what about this one? From the FDIC.gov itself.
And the funny part for me is our banker friends, most of their compliance is to prove that they're worthy of FDIC support. So they spent all their money with lawyers, with compliance people to prove that they're worthy of FDIC insurance. And this insurance is kind of bullshit.
Yeah. All right. Well, I don't know how to read these things. So
we're gonna refer you to much smarter people than us. We're just
yeah.
real estate investors, just trying to make a buck.
Just do this. FDIC is a sham.
Have you done this before?
No. I'm sure some of these has some good information for you. Anyways, folks.
Wait a minute. FDIC is a fraud. Medicare's a fraud. A Ponzi scheme. Oh my God.
All right, this is too much for folks. Let's get back to this. Okay, so what are negative interest rates? What does that mean?
So this is already happening. So since 2008, they've kept interest rates incredibly low to prime the economy, to get things going. And for you fans of Austrian economics, we all know that this is what primes the pump and creates the next bust. We're not saying there's going to be a next bust. We're not saying there's going to be a next bubble popping. But clearly there's times in history where artificially lowered interest rates have led to horrible, horrible things. So now, since 2008, they've kept interest rates incredibly low. No one's impressed with the recovery except for Paul Krugman, maybe every other week in his column. So what have they done? They've kept, if the theory is that low interest rates are so good for the economy, why wouldn't negative interest rates be great for the economy? And so if you're curious what a negative interest rate is, and it's already happening in Europe.
Negative isn't less than zero, or negative isn't bad.
Yes.
Or both.
That means as a depositor, you pay the bank you put your money in to store your money.
And this is already happening in Europe.
Yes.
Wow.
It's already happening in interbank lending rates on Wall Street.
Yeah. Don't you have a buddy who does this?
I do. Yeah, I do have a buddy who sells for a bank on Wall Street. And basically what he's selling is you won't have to pay me as much as the next bank to store my capital.
Wow.
So if we were back in the Renaissance and it was a goldsmith holding and protecting your gold, it would make sense to pay him a protection fee. But it makes zero sense to.
But I would only pay him that protection fee if I knew he wasn't going to loan out my money and there wasn't any risk there.
Yeah.
Right? Okay.
Google negative interest rates. I don't know if you need to do it on this YouTube video, but it's out there.
Don't do it right now. Don't do it while we're talking.
Yeah. And then there is another theory that there's a war on cash, that they don't want individuals to be able to take their cash out of the banking system and essentially be autonomous of this too big to fail system.
Well, if you take your cash out, then they can't loan it out 100 different times to everybody
or 10
else.
times. But yeah. So it's a control measure. We're not saying this is true. It's not true. I'm just saying this is a thought out there. Go ahead and Google
there's
it.
A little bit. I don't know if it's a conspiracy to it, but you don't need to Google it. Just if you got money in your bank account,
try to go get $10,000 cash today.
Go walk down to your bank, and it's not going to happen.
And the reason they say it is because only a drug dealer would want $10,000 in cash, or a terrorist.
Yeah. Okay.
We're just real estate investors. We're not conspiracy theorists.
All right. So if we've discussed why banks aren't a good place to store our capital, what can we do? Maybe stuff it under our mattress, but that's probably not too good of a solution. So, what do we look for?
It's not a horrible idea to have a month's worth.
Oh yeah, I mean, having cash, having some gold and silver is a good idea. We both have cash and gold and silver. I mean, it's just smart to have a little bit for a rainy day. That's not inside a bank. That's in your personal sphere of influence.
And there are recent examples of this happening in the world.
Yeah,
in Cyprus and Greece.
Yeah. But once you got your rainy day fund, that's a small amount of your total capital. What can you do with the rest to make sure it's in a good place?
So if we're going to store our capital somewhere and not put it into a house, not put it into another investment, here's a criteria of what it must do. It needs to beat inflation. There has to be tax advantages. I want minimal government regulation and oversight. You and me both went through military academies. We had SAMIs every Saturday. We've been regulated. We've been inspected. It's really tedious.
Yes.
It needs to be anti-fragile. Another reference to Taleb. Read that book. It's a great book. I don't want it to be subject to market volatility. I want it to be a place where I store it and it can collect a little bit of interest, not like real estate like returns.
Yeah, we're not talking about investing right now. We're talking about a place just to store capital and keep it for before you start to decide where to invest it. And this is like a tier one thing, like a foundation of your financial system.
Absolutely. And
hey guys, Jimmy
this
here. Me and Bob's discussion started going way too long. It turned into like a 45-minute YouTube video.
Cash flow
and even this video is going to be 25 minutes long. So we like to break it up. So if you're interested in finding out more, if you're interested in hearing the rest of our discussion, it's in another YouTube video called Where to Store Your Capital If You Don't Want to Use a Bank. So thanks for tuning in. Talk to you later. Bye.